Hi, it's Roman from PensionCraft. Let's say you choose a fund which has performed very well in the past year. How do you figure out whether that outperformance was due to skill, which should be rewarded, or whether they were just lucky, which shouldn't be rewarded? Watch this video to find out. As an investor, you have two choices: either do it yourself or hire a manager. In the first model, let's call it Gordon Gekko, you open a brokerage account and you choose your own shares and bonds. In the second model, you hand over your money to an expert. Here I've shown Warren Buffett, and in return for skillful investment and good returns, you pay that fund manager a fee. You choose your fund, it's performed very well over the last year. Is that outperformance relative to its peers due to luck or skill? Here are two hypothetical fund managers. Both have performed very well over the last year. The one on the left outperformed because of his deep and insightful analysis. The one on the right chose his investments randomly. His outperformance was simply because he was lucky. Standard & Poor's produce an incredibly useful report, which they call the Persistence Scorecard. They analyze 631 domestic US equity funds, and they track the funds to see how consistent they are. This is the best way to figure out if outperformance is due to skill or luck. Their findings are quite shocking. From September 2014, only 3% of the top quarter performing funds was still in the top quarter in September 2016. If we lengthen the horizon over which we track the funds, the story gets even worse. Over a 5-year period, only 1% of the large cap funds and none of the mid cap or small cap funds stayed in the top quarter. This strongly suggests that it's luck, not skill, that drives outperformance in US mutual funds. To see it as a picture, the box represents a list of all of the funds in 2014 ranked by performance. We choose one of the funds in the top quarter. 2 years pass, and now there's a 97% chance that the fund we chose is no longer in the top quarter. These facts are not new, but it's only recently that the messages started getting through. Capital is being withdrawn from active funds and shifted into passive funds, and a fund simply tracks the entire market very cheaply. There's been a massive switch from active management to passive management. To see the massive difference in fees, imagine we invested £100. We can either put it into a very cheap US equity tracker, where the cost would just be 7 pence per year, or we could put it into an actively managed hedge fund. These have very high fees, and their fund managers are supposed to be very skillful. For the hedge fund, we pay £1.40. One of the chief instigators of this passive revolution is John Bogle. He's the founder of the US money management company Vanguard, and this is a potted summary of his investment approach. He says select low-cost funds, and if you do take advice, consider the cost of that advice very carefully. Don't stampede into the funds which have the greatest performance recently, because as we've seen, it's unlikely that that outperformance will persist. Of course, we don't ignore past performance altogether. We can still look at consistency and risk based on those historic returns. But we should be aware of the culture of celebrity in fund management, because the stars of today will probably not be the stars of tomorrow. Fund size is also very important. Go for large funds where you get the greatest efficiency and the smallest trading costs. And if possible, try to keep your investments simple. Don't own too many funds, and once you have your fund, hold it, because trading costs will eat away your profit.